the structure of real estate private equity, there are two main people that are involved. You have investors who are commonly called limited partners. And so they will invest their capital into a fund. And the other side of the picture is people called general partners, and these will be managing the fund. So a real estate private equity fund is generally, it's a closed-ended fund, meaning that once you invest the money, it's an illiquid investment. So you're going to be tying yourself up for between 3 and 7 years. It can be slightly longer than this, but generally you're looking between 5 and 7 on average. And so the investors will be investing their capital into the fund, and what they will get back is something called distributions or cash. And so the distributions are quite lumpy, and it's a regular cash flow. It'll generally come towards the end of the fund life because real estate takes quite a long time to buy and invest in. And to get them distributions will generally be towards the middle to end. So they'll be looking for high returns of investment, and the general partners, they'll be looking to manage the fund. So the partners do services, so they'll be looking at acquiring and managing these real estate assets. Now, the general partners get out of this is performance fees and management fees. And it works on a 2 and 20 structure. So for performance, that's the 20% side, and that'll be generally above something called a hurdle rate. And so if the fund returns, say, 10% and the hurdle rate is 8%, they'll get a bonus of 20% of that extra return. There's hard hurdles and soft hurdles, and that's beyond the scope of this webinar, but they work on this 2 and 20 structure. The 2% refers to the management fee, and so every year they'll take 2% of the portfolio. So if the portfolio size was 100 million, every single year they'll collect £2 million in management fees. And so this is how the fund is structured. So you can see that it's a limited partnership. And so that's the general structure, and they'll be investing in real estate assets. Now, the fund works through something called a mandate, and the mandate will specify these top 5 things here on this slide. So it'll have risk profile. What type of risk and return are they looking to achieve? What about the debt to equity split? Although it's called real estate private equity, one would assume, well, we're going to invest a lot of equity into these deals. Well, actually, there's a lot of leveraging going on to achieve these high returns. So it'll give an idea on the range of loan to value ratios that the fund may use. The transaction sizes with real estate private equity are generally quite high, looking, generally in the tens of millions. It changes on per fund, but you're looking at large transaction sizes. In terms of property type, real estate private equity focus on commercial investments. And so these could be retail, office, industrial, warehousing, what have you. And it'll generally specify if they're going to have a diversified approach, invest in multiple different types of property, or if they're going to invest in only one area. And that'll be specified in this mandate. And of course, they'll have a geographical focus. So where in the world are they going to invest? Is it going to be in continental Europe, in Asia, in North America? And so this mandate covers these things in detail. And so it gives the investors the idea on what they're investing their capital into. Now, the PE firm will have multiple funds running at the same time, and their mandates will change between them all. And so it gives the investor opportunity, or the limited partner opportunity, to invest depending on what their portfolio preference is, what type of risk are they willing to bear, and what type of returns are they trying to achieve. The final thing to note about the private equity firm is that there's 2 sides to it. There's the acquisition side and the asset management side. And on the acquisition side, generally employees on the acquisition side will achieve higher salaries. And their goal is to find the deals, structure the financing, and to take that to the point of acquisition. And once that property has been purchased, it will then be sent to the asset management team. And at that point, they will be, their main goal is to ensure the smooth financial performance of the investment. And so there's the two sides that the sponsor firm really has to do. And as I said, you've got the limited partners, and the general partners are the ones managing it and getting them performance and management fees.